Hey guys, it's Adam Rose, Western Ohio Mortgage. I'm the Vice President and Senior Loan Officer located here in Sydney, Ohio, and this is another episode of the Mortgage Guy podcast. And this week, we're going to do a little bit of a shorter video and a little bit more buyer education. It's going to be 5 things that you shouldn't do or shouldn't worry about or something along those lines for buyers when you're getting into the market to purchase your first home. A lot of people are always worried about misconceptions, what you should do, what you shouldn't do, the no's, the do's, the don'ts, all this fun stuff. So I wanted to touch on, right? These are things that we talk to buyers about when we do their loan application. But, before you even jump into thinking about purchasing a home, it might be something that you want to consider or start making moves on to make sure we're not making any mistakes ahead of time, right? So let's talk about these. I got 5 things listed here that we should entertain or be thinking about when you're getting ready to purchase a home. So number 1, don't shop for a house without getting pre-approved, okay? This isn't just for me or yourself. This is also for your real estate agent, right? You call up an agent, you find a house online, you're like, hey, I want to go check this place out. First thing, please call your lender, right? Give us a shout, or whoever your buddy is that's doing your loan for you. Give them a call ahead of time. Let's start that process. We want to make sure the credit's there, right? We want to make sure the income's there. You're not falling in love with a house that you can't quite afford. Or maybe it's in a certain area and you have to go with a certain loan program and you don't have the money for the down payment. We want to work these options out way ahead of the game before you dive into the market and you fall in love with something that you just can't quite make work, right? So that's number 1, right? Let's go ahead and call your lender. Let's get it pre-approved. No square peg round hole this stuff. We want to make sure you're prepared to go. And don't assume, this is number 2, don't assume you need 20% down. We kind of touched on this last week, actually. There's a lot of loan programs out there that can help consumers that don't have a ton in savings or readily available for a down payment, or don't even want to allocate that much money that they've saved for a down payment. You have even with conventional financing, right? A lot of people think, hey, if I go conventional, I got to have 20% down or whatever it is. You can go as low as 3% down, right? There's other restrictions that apply, of course. But you can go as low as 3%. FHA is 3.5%. You got VA programs out there at zero money down. USDA programs at zero money down. So don't always assume that you have to have this large down payment. In this market, I have been advising people that maybe we minimize the down payment a little bit more. And why I suggest that, we are kind of at peak market conditions, right? Home values are very, very high right now. Rates are a touch bit high right now, so you're going to want to maybe refinance in the future. But the benefit is if you're buying a $100,000 house, instead of putting $20,000 down on the home, maybe you do $5,000 down payment, and that extra $15,000, can be used towards covering closing costs instead of asking for it to get your offer accepted. And you could use that excess money to purchase appliances or new furniture, or you get into the home and something goes south on you. Water heater goes out and you got a $1,200 repair. So don't always assume you have to have all this money saved. Maybe minimize that out-of-pocket expense, that down payment, and save for other things, just in case you run into it. Number 3, don't max out your credit card debt. All right. So this is kind of a big deal when it comes to credit. And this is something that you're going to want to do, not necessarily during the process, right, is before you decide to apply for a home loan. And it might be months in advance. So if you're ever even considering doing it, one of the first steps that we advise buyers to do to boost credit score is to make sure their credit utilization ratio is in line. So credit utilization ratio, what is that? So what it is taking a calculation of how much credit you have available to you versus how much you're actually using, right? So if you have a $10,000 limit on all your credit cards out there and you have a $5,000 balance, you're at a 50% credit utilization ratio. Well, the sweet spot really, really wants you, and don't think you have to pay everything off, because you don't, but it's that 25 to 33% range of credit utilization ratio is going to boost your score and maximize the points on a monthly basis. So this is something that you want to be in practice on way before you purchase a home, and even after you purchase a home, just to keep your credit score up where it needs to be, just in case you have to apply for financing for a car later down the road or something like that. So make sure you use that, you apply it, make those extra payments every month or a lump sum payment, and keep that balance right in line, or that 25 to 33% of 25 to 33% of the limit is where you want to keep that. Number 4, do not get on a spending spree because we're buying a new house and you feel like this beautiful new home, it needs a new car. Don't do it. Do not do it. So many people have made a mistake and have done this. they have shown up to the closing in a brand new vehicle, and the closer looks at it and goes, "That's really nice. Are those temporary tags?" Yeah, you just say no. All right. So don't buy the new vehicle. And the reason that is during this process, we do credit monitoring. Okay. So, at the beginning of the application, we say, hey, you know what? Don't take out any new credit cards. Don't jack them up. Don't make any major purchases. Don't buy a car. This is why. We're going to get a notification. You get a credit inquiry on your credit report. So you go down the road to Buckeye Ford or wherever you're going, and you decide that beautiful new truck look great in your new driveway. We're going to know. We're going to find out. So we get an email notification. Your credit gets pulled. And it's going to tell us if something new was taken out. And the reason it's a no-no is because we now have to count that new debt into your debt-to-income ratios. And you may not qualify anymore, even if you're right up to the finish line. Okay? Just don't do it. Don't do it. Number 5, this is the most important one. Do not quit your job. Do not switch employers in the middle of this process. Is it something we can remedy? Yes, we can remedy it, but it takes time. And in this market, when we have contract dates that we're running into, the last thing we want to do is delay your closing for X amount of days or X amount of weeks until your new employer gets us enough pay stubs to validate your employment history and that you have sufficient income in order to close on this house. All right? So no job switching whatsoever. And how are we going to find out? Well, it's like a small town, baby. We're going to find out. And the reason is because we're going to call your employer about 24 to 48 hours in advance of closing just to make sure you didn't make that change. And it's just a verbal verification of employment. And it's happened. I think every agent that might be watching this, it's happened to them. Same thing with the vehicle purchases. So just avoid it like the plague. All right, guys? The market's already hard enough. Let's not make it any harder on ourselves. We're getting to the finish line. Don't mess it up. And that's all I got for you this week, guys. So follow those tips. Let's get you prepped and ready to go to buy your new home. And again, take a look at our podcasts on Apple Podcasts and Spotify. Love this channel. Like it, share it with your friends, and subscribe on YouTube. And we will catch you guys next week.